Well, good morning or good early afternoon, depending upon your time zone. Welcome to your Interocean Quarterly Market Outlook and Update with Bhavna and myself. Bhavna, we were supposed to do this in person.
I know. I have to be honest, I did not want to travel to Scottsdale right now, is why we are doing it this way.
Why? Is it because it's 115 every day?
That might have something to do with it.
Is it because if you drop your car key in the parking lot, it might just sink into the hot magma soup? Honestly, you will see this time of year in Arizona, you'll see there will be I know people don't carry change around anymore, but if you do see it in certain parking lots, when it gets hot enough, that change will melt into the road. It's pretty awesome. You don't get that in Nashville. But maybe we should convene. I would say we just opened a Dallas office. I don't think Dallas weather is a heck of a lot better.
True.
I mean,
we need to start opening new offices in more weather appropriate locations, I guess.
Well, we should have reached out to Art, to Art and David in our new Detroit.
That's more like it. Yes.
I know. Because I think there's, they're near, their offices near lakes and all that stuff. And we should know these things. And again, you're right. We should be basing our co-location of these market outlooks on who has the best weather.
Yes, I think that's a great plan. I'm on board with that. Sign me up.
October, I still don't think we're in Arizona. I don't think we're in Arizona.
No, Nashville is good in October. So we'll land on Nashville for our next one.
Okay. Well, listen, a couple of notes. So number one, why we're doing the market outlook. If you're tuning into the market outlook, the reason why is not only do you just love what we do, we appreciate that. And we appreciate all the good feedback and questions and thoughts that you have. But, you're constantly being inundated with opinions from folks that family members, things that you hear on TV, television, you're catching or you're reading, and some of it's fact, some of it's tilted facts or fictional completely. And you're tuning into this because what we do is we take economic data and we're sorting through it and we're looking to share with you what we see in the data and how that's shaping our thoughts about the market and ultimately shaping the portfolios that you're investing in with us. So again, we appreciate that. I also want to make sure that you're aware that on the bottom of your screen, there should be a little chat button. And Josh is there. He is ready. And thank you for emailing questions because some of you did, and we'll try to get to all those. But if you do have questions, just, again, don't hesitate. Josh will grab those questions and then he'll shoot them over, and throughout the presentation, we'll try to get them all in, and depending upon how many we have, maybe we'll have a separate Q&A after the fact. That was a longer intro than I think you thought was going to come, Bhavna, right? Too long.
Yeah, but great pointers to remind everyone. I know a lot of clients have been tuning in regularly, so they already know this, but we have so many new clients joining in every quarter we do it. In some ways, it feels like we did the last one so long ago because so much has happened in the market in the last.
What are you talking? Nothing's happened. Nothing happened.
Wait till the end of this presentation and you would know how much has happened through these last months. But it also feels like we just did the last one. So I'm excited to get going.
I know.
And dive into all the different topics, interesting and fun topics that we have talking about today.
Yeah, so listen, so if you're sitting down, you want to buckle your seatbelt because there's a lot here, economically speaking. Be prepared to be amazed. All right, you ready? Here we go. Let's dive in. Here's the market outlook. As always, we've got the agenda here. We're going to cover 10 different topics, piece by piece by piece. We're going to try to get to, again, all of your questions, all your thoughts, and everything that we think is relevant. But again, if there's something that you want to know that we haven't covered or not covering, do go to that little chat at the bottom of your screen, and Josh is there waiting. He'll let us know when questions come. You don't have to wait too long. All right, so with that,
Josh, remember, don't send through any difficult questions, only send through the easy questions.
No way. Send them. Make sure you put, if it's a really hard one, put Bhavna, and then and then that's good. Listen, you're a CPA and CFA, you deserve to have the hard questions. All right, so As Bhavna and I were talking a little earlier, we like the subject line, piercing the ceiling. Really, this quarter's return is really about that. It was marked with, and as well highlight, the debt ceiling was lifted. A huge concern that that we highlighted in our last market outlook. We hoped wasn't going to be an issue. The government was able to come to some type of a short-term resolution. So the debt ceiling was lifted and the markets were off to the races. Through the end of June, big US stocks are up about, let's call it about 17%. And you're looking through about this morning, this is again, through the end of the quarter, even updated through today, market's up almost 20%. That's a huge relief rally. And we're going to talk a little bit about how sustainable this rally is and if what you saw in the first part of the year can be something that you can rely on in the next part of the year, because not only did you see a great rally in large stocks, we saw some broader participation, which took a little bit of time to come through, but it eventually did come through, which to many analysts, experts, even us here internally, was indicative of a stock market that as it was finding its breath, as more parts of the market were participating, it was confirming like, well, maybe this thing has a little bit more legs than we originally thought. You saw even a really nice rebound in credit, which is again, another word for bonds. Government bonds had a decent rebound, which is good. And the alts, if we had more time, I'd talk more about it, participated okay, but certainly weren't all that great. And a lot is being made of this, and this is kind of a new term. Kramer is, sometimes he's right, sometimes he's wrong. He's certainly entertaining, I'll give him that. And so he coined this term Magnificent Seven, and the Magnificent Seven are right there on the bottom, your Apple, Microsoft, Google, Amazon, Facebook, NVIDIA, Tesla. Those Magnificent Seven really led the market. I'll talk a little bit more about how much so, but what's interesting is that these 7 stocks, for as much as they're performing this year, which is this point after this dotted line, isn't it interesting that if you take into consideration how badly they performed last year, we're really back to where we started.
Right.
Bhavna, it's like, you want to be like, this is going to go forever, or I should only always have invested in these companies, but that's just not how it works.
It's always so fascinating to me, Michael, that if you change the timeline of the analysis that you're doing, you're shocked to see how the results and the observations just change on you. And this is just another classic example. Just expand the timeline a little bit and the story just completely changes.
Right. So we are large owners of each of these Magnificent Seven at InterOcean. I assume many, if not all of you on this call own them through us, which is great. We love them. But that's not the whole story. We'll try to break, again, more down in terms of what we're seeing, what we're investing in, why. But it is interesting to note that the Magnificent Seven is not something that we're just going to hang our hat on and say, okay, we're good, in perpetuity. This is, I think, a really nice way to break down the 3 months of the quarter. This first, again, April, the market was up 1.5. There was cautious optimism. In May, what's going to happen with the debt ceiling? The debt ceiling gets done right here in this little President Biden announces the debt ceiling deal. Market jumps, there's a little bit of confusion. And then because again, the minute the debt ceiling passes, it was a buy the rumor, sell on the news kind of moment. Market sold off, and then it was really off to the races, where we got past some of the things that were potentially binding the market and holding it lower, that uncertainty.
Again, so interesting to see how the sentiments have shifted so much within as short a period as 3 months. And this chart does such a good job at actually outlining that month on month and how everything just was off to the races in June. And we kind of saw a little bit of that shift in sentiment with some client conversations as well, wherein, if you were having conversations in late April, early May, heading into that X day, you remember a lot of conversations happening about the X date, and clients were starting to talk more and more about that fear, and, that just general, fear around the system collapsing in a way that it would never be the same again. And that started reflecting in some of their the discussions around the portfolio. And it's kind of been interesting to see how all of that has become so far back into the history of everyone's memory. Although we know that debt ceiling again has become a more commonplace discussion every few years. I feel like we go through the same emotions with it. We know that it will get resolved in the 11th hour in a very dramatic fashion, but it is still a very, very real topic. And it's interesting to see how it kind of played such a big role in a month, how the sentiments were shifting on a month-on-month basis. So much so that, I feel like in a very, very short period of time, the consumer sentiment has gone from fear to now kind of pushing towards that greed index back again, which it's the pace and the speed of it has been just fascinating.
We had so many slides that, Bhavna, that we did end up deleting the fear and greed index. Just so to your point, we are on that greed lever, meaning this tends to be the kind of market environment where stocks become fully valued a lot more. We're going to break down on that, but it is endlessly interesting to me where so people are much more worried about missing the upside now. So when we're looking at that leadership, I mentioned that it was narrow. No more clear can I make it that when you see technology stocks up 45% for the first 6 months of the year, no participation in healthcare, energy, or utilities. The top 10 names, contributed 13.3% of the total, 16.9% of the return. I told you I was going to have this broken down a whole bunch of different ways, but it was so heavily tilted towards the largest companies. And we know that it was really just a reversion rally, taking back what largely was lost in 2022, that it doesn't create new confirmations for us here at InterOcean that we need to then suddenly tilt everyone's portfolio to the top 10 holdings. We acknowledge that that's been great. Our clients have been beneficiaries of that, largely speaking. And the questions become like, where do we need to go moving here? Because we're looking at the premiums of some of these stocks. We're looking at the relative valuations of some of these stocks, which Bhavna will cover in great detail, is saying, geez, are we fully valued? Another way of looking at it that, we're seeing this index concentration. And what this is showing us is on a historical basis, those 10 largest companies, how much of the index do they make up over time? So that .com bubble bursting, where the biggest tech companies dominated the index at that point, those top 10 stocks were 26.6% of the index. That was like astronomical, amazing. And then you saw slowly over time, there was more participation, other companies performing well. Not saying that those big companies didn't perform, but their performance relative to everybody else wasn't so dramatic as others caught up. And as you're looking, we kind of hit this COVID peak of where those top 10 companies made up 30% of the S&P 500 index. And then presently today, we're still sitting at relative highs where there's just undue influence. So you would think, Bhavna, that because of where these biggest stocks are, that we should see some kind of pause in them. So if anything, if we're looking for value and valuation, we might have to start to look elsewhere.
Just staying on that last chart, one another interesting fact that I wanted to bring up while topic of index concentration is, we were looking at the S&P 500 index on that, but when we look at the NASDAQ 100 and the concentration in that index, it's gotten to so out of hand that they had to actually do a special rebalancing of that index because the largest 7 companies were becoming as big as 55% of that index. And they had to come up with special rules to say that, okay, the larger companies cannot be more than, I think they're trying to cap it at around 40%, which is still very fairly concentrated. It's been interesting to see that they have to actually bring in special rules to try and break that concentration, because the market isn't obviously breaking that concentration. It's actually just adding to it on an everyday basis.
It is. By the way, we had a good question about our ETFs, if we're leaning more towards emerging markets. Again, to me, that's more of a portfolio rebalancing trade than anything else. Do you have any comments that you'd like to make on emerging markets relative?
Yeah, no, we've definitely over the past few years, we've carried obviously a little more overweight to the US sector, in terms of geographical concentration within that international portfolio. In some of our core strategies, we are still, I would say, very heavily lean towards the US, but for some of the strategies wherein we have a more global exposure, we're definitely starting to add back to our international non-US exposure, and within that, trying to be more tactical about, also starting to look at small and mid cap, also starting to look into value indexes. And that's something that we will talk about a little later in the conversation as well. But generally speaking, the highlight really is that while there will be a lot of discussion about, broadly speaking, the equity markets are starting to look a little expensive, when you start peeling through the concentration aspects, the lack of breadth, etc., you'd start realizing that there are a lot of other opportunities beneath the surface that are more reasonably priced and are better positioned for future growth. And we have definitely started to align ourselves to some of those opportunities on the horizon.
Hey, Ken, I want to shout out to Ken for that great question. And I think Bhavna is just saying yes. Sorry, I had to do it. Okay, Bhavna, banking outlook. I don't want to fall behind. Hit it.
Why are we talking about the banks? I feel like banks is so first quarter. No one wants to talk. I feel like everyone has forgotten about.
Totally forgot.
We were going through in February and March.
It was one of our signature parts of the last market outlook. And now
we had a whole section just on SVB and the banks, and I feel like everyone has already moved on from it. And it's all about AI. It's all about Magnificent Seven, and who cares about the banks? Banks are not important anymore in the portfolio. But this is a gentle reminder to everyone that banks are, a very, very critical part of our economy, and anything that happens in the banking industry has such far-reaching effects on not just the overall state of the economy, but also a lot of on the policy issues, and we'll talk about that in when we chat about the Federal Reserve. But so coming back, wanting to spend some time on the banking sector, I feel like the issues that we were talking about the banks 3 months ago are still very existent. Those haven't resolved each other. It's kind of fallen off the headlines. But when you start looking through, the growth that the commercial bank deposits have seen so far into the year, it's a negative number versus what they generally on average see so far into the year. So it's been pretty interesting to see that the deposits, the year-on-year change in deposits is actually still slowing down. There is no recovery there, which again has far-reaching effects on everything. It has severe effects on the bank's ability to be able to lend in a stable fashion. So again, that issue hasn't resolved itself. It's still going on and existing pretty much like it was last quarter. Moving on from there, another thing that I wanted to talk about was, again, commercial real estate, because that's another very important.
I thought that was done. We're good now.
Sorry, go ahead.
We're good now. We're good.
Yeah, we are good, because again, no one wants to talk about it anymore, I guess. So we can forget about it. But no, the vacancy rates across the US metro cities has been climbing up. There is also that phenomena still at play of workers still wanting to work from home. So generally the occupancy rates aren't that high across commercial offices, which will also keep reflecting into the vacancy rates, possibly continuing to keep going higher as more and more leases kind of roll off the balance sheet. So still an issue not resolving itself, still pretty existent. Let's move on to the next slide.
Yes.
And another interesting thing about looking at how the banking sector, especially the regional banking sector, has done so far into the year is, one, the regional banks in terms of their price performance have continued to struggle. So for instance, at the end of June, the regional banking sector was down 30% year to date, which was pretty strong. It has recovered back a little bit in July, but it's still in a pretty bad shape in terms of the overall performance year to date, as well as the cost to insure against regional bank defaults is still very elevated when you look at it in a slightly more historical
Yes,
context,
yes.
which these are all symptoms and telltale signs of that everything beneath the surface is not all good, and we don't have to worry about or talk about what's going on in the banking sector. So there's a lot of signals that we still need to continue to keep paying a lot of attention to.
I agree. Well, how about this? I mean, how about this one right here?
So
Honestly.
again, all of this matters because the bank's ability to hold on to those deposits is directly related to how much can they keep lending. And that has a broader implication on the economic growth in general. And again, so far what we've seen in terms of trend lines is that's both small and large banks lending growth is slowing down. I would say it's probably a little more prominent in the small banking sector, which is actually a lot more critical and important for small to mid-sized businesses in the US. Again, core of the economic health, so to say. So again, a lot of different indicators, which is still giving stress signs. And again, just wrapping it all around, why do we want to take all this time and talk about the banking sector is that if this credit contraction, the lending contraction continues on, this will have far-reaching effects on bringing more slowness in the economy. And the Fed, acknowledges that it doesn't truly fully is paying attention to or fully acknowledging the effect this credit contraction can bring into the economies, let alone the quantitative tightening that they're doing on their own. And both those factors combined together has a lot of lagging effect. We don't fully truly understand the implications of those on the economy in the long term, which kind of puts the Fed in a little bit of a uncertain spot in terms of, do they really think what they are doing, or do they truly fully understand the implications of every decision that they're making and will be making in the year as it unfolds.
Got it. Well, so we need to pay attention to the banks. By the way, do you like my laser pointer? I forgot that.
I do.
So I forgot. Now I can't help myself. I think I even need the laser pointer right now. Can you see this, by the way?
I can. Yeah, there's a red.
Yeah. Okay. So here's what I thought this is fun. So again, we're looking at what the Fed's looking at. The Fed's mandates are, hey, what's going on with inflation? What's going on with jobs? What's going on with growth? Those are really their priorities. When you look at things like the labor market here in this dotted line, this is kind of that average, expansion within the job market. And we're in this blue bar, you're seeing we're above trend month after month after month after month. Job market continuing to do well, defy gravity, if you will. The Fed's unemployment target, another way of looking at this data, we're ahead of schedule with the unemployment target. And wages, the word relatively high is a little bit misleading because we're going to talk a bit about the consumer here in a minute, but yes, wages are higher, but we know inflation's taken a big bite out of those wages. So before we get too excited about the wage growth, we know that it's there, but we also know that, again, on an inflation adjusted basis, it tells a bit of a different story. And the household paychecks proxy, we're seeing where inflation is on an inflation adjusted basis. Even though paychecks have improved, paycheck less inflation is certainly telling a different story. Slightly better than where they have been, but not not a ton for us to be celebrating in real meaningful fashion. So with that, let me see. Got to advance the slide here. Here we go. Okay. Yet at the same, I'm just going to sum this up. Yet at the same time, the Federal Reserve governors are saying, you're looking at, their inflation measures, their preferred inflation measures, which is the PCE, and it's coming in on the better part of their expectations. You're looking at where they're forecasting our US economic output to be, and that's on the high side of their expectations. And you're looking at the unemployment, and the Fed is saying better than expected. So the Fed is saying better, better, better on three key components of the economy, which is why everyone's singing the chorus of soft landing. Ta-da. But it's just not this whole kind of Goldilocks soft landing thing. We're going to unpack that in greater detail. But the way the economic data looks at this moment, it does appear that that's what is happening. And it's whether or not it will happen that determines market performance.
Right.
So we're acknowledging that the economic data looks good. We're acknowledging what the Fed governors are seeing is great. We're acknowledging the fact that, largely speaking, that those people that normally would criticize the Fed right now are singing their praises, because it does seem to be that the interest rate increases have had this impact on improving inflation. We're going to see. We're going to see.
And again, I understand there is a little bit of a bias. If you're in charge of a specific goal that you've been, hired for, you do want everyone to believe that you have everything in control. And therefore, again, the narrative makes sense that if you can, exude that confidence in everyone saying, we got this, we are in charge, we are in control. And we somehow have figured out that magic formula saying, we just need 2 more rate hikes, and it would be we'll be at the exact precise spot that we need to be, and it would be perfect. Every time you think about something that gives you the impression that it will be a perfect scenario, you do need to kind of have a little bit of a caution around it, saying, is that too good to be true? Is there something that's obviously missing from that equation? Because again, the Fed doesn't really have a strong track record of doing things in the exact perfect fashion that they're expected to do and get it always right. They
don't let their prior history of screwing things up jade you, Bhavna. Don't let that, because I know. So all that notwithstanding, all those good things notwithstanding, in all that history, which some good, some bad. Here's what the data is suggestive of inflation going forward, and you need to be aware of this. So if you're not, you can't blame us anymore, because we know, and by the way, we see there's people continuing to join the chat, which is great. Speaking of chat, on the bottom of your screen, if you've got questions, there's a little chat button. Josh is watching, waiting, relaying the questions to us. We're doing the best we can to weave those questions in. They can't all be as good as Ken's questions, but you know what? You can always try. Okay, so here's where the inflation numbers were in 2021. We know the COVID story. We know the fact that goods were tight. We know that people were ordering more things as they were shut in. We got that. And we saw the relative improvement from where the inflation numbers were to where they went in 2022. So we know that the government numbers of inflation, which they say peaked at 9, are coming down. And we get all that. And we've seen prints better than 4%. We know all of that. That's great, 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 great. Can the raising of interest rates explain all of that? It's dubious to me that it will. Dubious is a word. It seems very unlikely to me, but okay. But here's the salient point in yellow. Going forward, what we know is we know that the comparable inflation data of a year ago to today, you're not seeing those easy numbers to jump over, meaning when we had the invasion in Ukraine and you saw oil prices jump, and then, yes, you're looking at kind of the change in energy prices, it was massive. And then you compare the Ukraine invasion to a year later and wow, it was a lot less, inflation's coming down. Well, now we're looking at the year-over-year comparable numbers, and we know that the energy numbers won't be there. We know that the supply constraint numbers aren't going to be there because those comparables are gone. And really what we're left with is we got home prices, which are starting to creep up a little bit. We see wages that are still pretty strong, and energy prices aren't gonna be negative. In fact, we're starting to see energy prices rise a little bit. So if you're looking at the Cleveland Fed Nowcast, which is the latest data in terms of what's expected, of course, it's a nice even number, but this is what the data suggests, is that, wow, is that 0.2 appears to be the norm. And if that's the case, what we can expect from inflation moving forward may be something like this. And you got two sides of the coin. You got the headline inflation numbers when no one gets a paper anymore, Bhavna, but if you did, what would be on the front page of the business, the headline number would be featured here on the left. And it shows that if you got a 0.2 with the Fed Nowcast, inflation would, on a headline basis, actually go up between now and the end of the year. If we did. So remember all this kumbaya, the Fed's increasing rates, and look the beautiful symphony with which that the market has responded and the inflation's responded. The comparables, the data, the comparables aren't there. So I wouldn't be surprised to see inflation come back up. And you're looking at the core CPI, which is one of the things that, by the way, the core CPI never hit 3. You're seeing it just peaked below 5. And so, yeah, if we get that 0.2, maybe core inflation by the end of the year ends at 4.2, but that's still pretty hot. So the Fed knows this, Bhavna, and that's why the Fed's talking about, we're going to keep doing more increases to interest rates. They're projecting another 2. They know that this data is out there. They know the comparables. And that's why you could have an economy that seems to be doing well. Inflation's coming down. Why would the Fed be increasing rates still? That's why. They see the data. They know what's coming. And I'm not sure that the market's fully appreciated and reflected on what those other interest rate increases may do to the economy. Certainly could create some confusion. But we'll
right. Again, it's been interesting to see how within the last 3 years we went from don't worry about inflation, it's transitory. You will see some big prints, but just ignore it. It'll come down. And we went through those phases. Like last year, June was the 9% year-on-year CPI print, which was very painful for us to live through. But again, at that point, the general sentiment was, okay, this will never end. Transitory was such a misleading word, and this is here to stay. Again, I now feel that with the most recent CPI print, now we're acting so surprised that it came down from 9%, but wasn't that the whole idea that it can't stay at that 9% forever because it was propped up for very specific reasons? Because
yes, the invasion.
It's like every time we kind of go through the motions, we end up reacting in a completely different way and kind of forget about what the historic context of how we ended up in that first place. And the Fed, I feel like, is kind of doing that to some extent as well with their forecasts and, how they're looking at the rest of the year in terms of the data and the numbers.
We're going to have to scoot through some slides. We're going to have to scoot. I know. Listen, I know this is going to be the first 4-hour podcast. No, we're not going to do 4 hours. We're going to scoot. I promise. Point is that we also know, historically speaking, that if you watch you remember, don't fight the Fed, that statement, as the Fed goes, so goes the market. We're expecting Fed liquidity to kind of embody this. This is not, by the way, this is the greater, this is what the Fed has indicated that they're going to be doing with their liquidity. If they indeed end up doing this, you tend to see that there's a pretty decent link that as the Fed reduces their balance sheet, the blue here in the market tends to follow. When the Fed bumps up their balance sheet, you see that it provides more liquidity. Either way you look at it, the market tends to respond favorably. We're kind of getting to the end. We're seeing the Fed pulling the wool out. This would be a very interesting delinking if that happened. But Bhavna, is the stock market cheaper, overvalued, or undervalued? Where are we?
Where are we? That's an incredible question. So let's dive right into it.
I'm there.
Again, we talked about, the year-to-date performances that we've seen, how the Magnificent Seven and the top 10 companies have just, exploded in terms of their year-to-date performance. So let's put all of that into context. Where we are with the S&P 500 valuation levels right now, it's certainly way above the historic averages we have. And another interesting anecdote about that is that all of that so far into this year is what we call a multiple expansion, meaning if you move to the next slide, I to a very interesting chart on that as well. I think it's on the slide next to it, I guess. Yes, on the one on the left. So
I'll go back.
Look at the year-to-date earnings forecast.
Let me get my laser.
Earnings growth. I mean, it's been negative. That purple line that you see on the chart on the left, it's been a negative growth in earnings.
Yes.
And yet we see the price of the S&P 500 index kind of just skyrocketing from where we were at the since last year. So all of that is what's, I'm referencing to as the multiple expansion. We're essentially just paying more for less. So there are these companies that are earning less on a year-on-year basis, but we're just paying a higher price for these companies. So it's pretty interesting to see.
Go back a slide, by the way.
Yeah, actually we can stay here.
Okay.
We can stay here and talk about, again, definitely those top 2 largest stocks. are doing a little bit of a heavy lifting here as well. So in terms of that multiple premium and what we are paying for those bigger companies, just because they've run up so much in their pricing so far into this year, they're definitely looking more expensive. And we're starting to see a little bit of a disaggregation within the S&P 500 when we look at the 10 largest stocks and we look at the rest of the 490 stocks in the S&P 500, we're starting to see a little bit of a disconnection in terms of their overall valuation level. So I would probably just conclude this section by saying that on the overall basis, yes, the valuation multiples for the broader markets do look expensive, but we also know that there are certain very specific phenomena at play in terms of the index concentration, etc. And therefore, we definitely see and recognize the fact that the overvaluation or the more expensive multiples isn't something that's equally applicable to everything in the market, whether you look at it from different market capitalization segmentations. Large caps are kind of getting richer on valuation, but small and mid cap look more promising from a valuation perspective. And then there's also every sector is not the same. So for instance, if you move to the next slide,
I'm happy to. You want me to go to one before, didn't you?
The one after this, which talks about the sectors.
I go wherever you want me to go. I'll go wherever you want me to go.
No, this one is, again, there are sectors that have done differently so far into this year, and consumer discretionary and communication and tech definitely are those company, sectors that have kind of done better this year and are starting to get a little more stretched in their valuations. But there are still also sectors that are not there yet. For example, energy and real estate are two examples that those are the two sectors that are currently trading below their 20-year average valuation. So the bottom line being, whatever we say about the broader market, we can't necessarily apply that to every segment of the market, whether it's through market cap lens or through sector lens.
That's right, Bhavna. That is right. Here? Yes. Are we on economic? Yeah, good.
Yeah,
that's me.
Let's do this. Yeah, that's you.
Oh, well, we got to talk about the economy. By the way, I was just ferreting through a bunch of good questions. So great questions. Keep them coming. A couple of questions, we'll get to them because we're going to talk a little bit about consumers and stuff like that. So thank you for responding. You got the chat thing on the bottom. Josh is there. He's sending me the messages. There was also a question about changing your view. There's ways to change your view in on Zoom, where you can see the charts and Bhavna and I at the same time. Who doesn't want to see us both? I mean, honestly, you can just look at just the charts, but you can get more pleasure by doing both. So just know that that's also kind of in the top right-hand corner of your screen. You can make that adjustment. Okay, so with that, we're going to talk a little bit about the economy. There's really two big parts of the economy that we're going to address here, because I tried to boil it down to the most salient critical ways that we can look at our economy broadly here in the United States, and that's both manufacturing and services. We're going to start with manufacturing. Lots of people say, Michael, who cares about manufacturing? Because it's only 30% of the economy. And I agree. It is only 30% of the economy. It is a critical part of the economy. And if we're losing part of our economy, that's going to have a greater impact on the overall economic output. It speaks to the health of our economic system. So let's take we're going to take the pulse of manufacturing as expressed here in PMI. PMI, anything over 50, this black line. Again, going back to 2002, anything over the black line is indicative of manufacturing that's growing here in the United States. Anything below the black line is indicative of manufacturing shrinking. Very simply put. And sometimes manufacturing shrinks so much that you get these gray bars, which is a recession. So here's where we are right now. This is a pretty meaningful shrinking in manufacturing. So there's really a couple sides of the coin. You would say, if you're the optimist, you would say, I'm not worried about manufacturing shrinking because we just had such a massive boom here as all this COVID ordering. We had to produce a ton of goods. We produced them, and yeah, it's going to take time for us to work through those goods. This is just a momentary respite off of a really good environment, and I'll agree to that. But I'll also say that this high peak is also really in response to this low here. So I don't buy into the kind of the bull case that don't worry about manufacturing because it's just in response to. I look at it and say, man, this is a pretty relative historic low. We're watching this carefully. I'll explain why in the next slide. And then because you're looking at like new orders, and if you're looking at new orders here in gold, yeah, you know, it bounces around, but you can see this trend is pretty clear that there's a lot sitting in inventory and we're not getting a ton of new orders to replenish that inventory. Inventory's lagging. So you're seeing it have an impact on manufacturing employment as well. So
Right. And when you look at it from a new orders perspective, I think you can also, you know, argue back on that, saying we can't still pinning this down on this is all just still, you know, the COVID effects, because it's not, you know, there is a bigger trend here than just trying to still recover back from all the supply chain bottlenecks we went through.
100%. 100%. And here's the and we're always looking for historical context to provide us good guides in terms of where we're going. So the historical context is just this. You can go back to 1948 and you can look at all the different economic environments that we've had. All these gray bars are recessions. There's a lot of different reasons why we had recessions. But what's interesting is, you know, when you have these ISM manufacturing numbers that are as horrible as the one that we have now, it typically comes with a recession. And the one time here in purple that we had, you know, these manufacturing numbers that were just as bad today, here's where we are today, was 1952. And in 1952, we didn't have a recession. But every other time here in red, where the manufacturing numbers contracted just like this, it came with a recession. So when we're looking for economic strength, manufacturing is not painting a real strong economic picture for us. In fact, you would also suggest that with manufacturing being what it is right now, that we should be in a recession right this moment. And if we're not, this would be the exception more so than the rule. Okay, but what about services? Because services is 70% of the economy. And we all like to focus on services because we all have, you know, it's not just haircuts, it's, you know, dentists and doctors and lawyers and financial advisors, of course, in the services sector. And how's the services sector doing? Again, how you read this is everything over the 50, or everything over the black line is economic expansion. Everything below the black line under the 50 is economic contraction. And when you have services that contract, and that's 70% of the economy, it's really unlikely you don't have a recession. Well, wow, we flirted with a little bit of contraction here. We quickly reversed, but here's the trend. The trend is a little bit concerning. You're seeing lower highs, and you're seeing, we're looking to see where the next low comes in, because the next low may be indeed a contraction. And we're also, again, here's new orders, but in the services side, we looked at new orders manufacturing. We look at new orders on the services side. Here's what the trend shows. It is still in gold, a pretty negative downward trend. So from an economic standpoint, both services and manufacturing, manufacturing is giving us some pretty difficult warning signs, particularly on a historical basis. And then we're seeing on the services side, we're seeing things that are slowing down. So we're aware of all that stuff. And then we're going to fold this into commodity, because who doesn't love oil and gold, Bhavna? Everyone loves oil and gold. They need their oil and gold update. You're like, give it to me. Because I know, I haven't looked at the questions in a bit, but I'm sure there's at least one gold question. So I'm going to answer that gold question before it even comes. So here's your gold answer. It has been pretty lousy. It's been pretty lousy from July of 2020, the past couple of years, gold here, obviously in the gold bar. The best performing commodity sector, you know, has been, you know, this, the midstream energy, which, by the way, you know, kudos to us in our tactical and trade portfolio, was our largest exposure point in 2022. We took it off in the beginning of 2023. We just put it back on again. So we are seeing some pretty decent signs out of midstream energy. We'll talk a little bit more about what that is and why. We're a little bit broadly speaking about REITs. So not all real estate investments are created equal. Some we like more than others, but broadly speaking, there's a little bit, we're not at the point where we're generally excited about getting an opportunistic investment in real estate, but believe me, we are looking, and we'll be happy to jump on it when the time is right, hopefully. We have to look at this number because I think this is pretty interesting to me. Remember how the Biden administration was releasing those strategic petroleum reserves to push down the price of gas? We
Because
talked about it.
yeah, because we don't need oil and gas anymore in our
Oh,
future.
I know. We can't, yeah. Gosh, remember this 4-hour podcast thing? We could do an hour just on that. But here's the point. So the strategic petroleum reserves, our inventories go up, and sometimes we release them, and they go up and we release them, and sometimes we have more. And the Biden administration released petroleum reserves to such a point where, my goodness, we haven't been this low in decades.
Mhm.
In decades. So that has done a lot to push down the price of oil and gas and what you're seeing at the pump. So what we're going to start to see, and this is, by the way, another way of graphically looking at the strategic petroleum reserves and what's been released. The announcement is 6 million barrels to be replenished in August. We're going to see this number start to reverse itself for the first time in years. So I wouldn't be surprised to see a change of the price of the pump. I'm not surprised to see the price of oil already responding, going higher. Another way of looking at it, as you're looking at crude oil inventories, and you're looking at US gas inventories, where we are right now, we just do not have a lot of inventory, certainly in gas. Here's where we are in crude, doing a little bit better. This has a lot to do with refinery capacity, but big picture point here is this. One of the things that we've benefited from is a reduction in the price of energy, both at the pump, what you're paying at the home for utilities, those kinds of things. We're starting to see that trend bottom out and start to reverse itself. I don't see a major improvement there. One, because the strategic petroleum reserves have already been released, largely speaking, and I don't see that continuing to provide us a boost to reduce the price of energy. And this is the same darn chart that I show you guys every quarter. I'm looking at the rig count, and yes, we were bringing more rigs online once after COVID, but look, here we go again. The number of rigs, whether it be for oil or for natural gas, we're seeing the number of rigs to extract the commodities out of the ground drop again. Bhavna, this is a simple issue. The less supply, the less rigs, the lower the supply. The less supply you have, the higher the price.
Yeah. And
Ta-da.
again, it's so unfortunate that we pay attention to this only after the prices at the pumps have already gone up, is when we start taking actions about it. And then when it's, we see a little bit of an easiness on that, we want to forget about this sector without realizing that, again, we haven't made the transition to clean energy fully yet. So we're still very, very dependent on this sector, and we can't just let it leave it alone, just left to dry. And it's been discouraging to see that the attention that was given to the oil and gas companies last year, because we needed them in that need of hour, is starting to dissipate again. And it's kind of reflecting in all the numbers across the board, especially the rig count, because this is a really good way to look at what to expect in the industry in the upcoming months and years.
I would be remiss if I didn't mention these couple of quick things. Is that number one, pay attention to the phosphorus reserves that they found in Europe. That could do a lot to help reducing the price of batteries, which could do a lot to help alleviate expedite the use of things like electric vehicles, which again, anything that you can do to reduce the price of batteries is going to be notable. That's a huge thing. And also note that Tesla and Toyota both happen to announce this most recent quarter that they have cars that can go over 700 miles to the charge, closer to 800. 800! Holy cow! So, I mean, when we're talking about energy, listen, we are an all of the above firm here. We believe in all of it. And we're just trying to forecast the trends. And so for right now, we're looking at midstream energy as one that, makes some sense for some portfolios. I had to go big screen for that, Bhavna.
Go
I
for
couldn't
it.
help it. 'Cause I never chart on it. So let's go. Let's go. Consumer. Oh, yeah. So we had a question about the consumer.
We
If you don't
did,
answer it naturally, I will ask it because we got a question from the audience. And don't forget, chat button on the bottom. Ask the questions. Josh is listening. We're listening. Go ahead.
So Michael, go for it. I know this is your favorite topic.
Oh, I get to do consumer?
Consumers. Yeah.
Oh, I love the consumer. So here's where we are. So again, we're looking at the inflation. These are kind of the broader government numbers where, remember, the Fed celebrating, confetti comes down because inflation measured as CPI is coming down. And then we're looking at the average hourly earnings growth again. So there is continued growth in average hourly earnings across the country, but look at the rate of growth. The rate of growth is coming down, which means it's growing, but albeit slower, because inflation is improving, which is wonderful. So this is the rub. This is the chart with consumers. I'm sorry, I am pounding the table, but this is what you need. You have to understand this. It's so critical because this is what you'll hear sometimes, is that average hourly earnings have been expanded massively since the end of 2019. I'm not going to disagree with that, Bob. No, you can't disagree with that either.
No, but I do remember this chart from our last commentary wherein we didn't see that 100.1. We were still in that net negative here.
Yes, yeah, but this is it. So yes, despite the fact that these numbers are real, $118 is real. So the fact that that wage earners have gone, the wages have increased by 18%. That's great, but on an inflation adjusted basis, because we know the cost of living has gone up, and because we know the cost of living has gone up on an inflation adjusted basis, wages haven't moved anything. So there really hasn't been a real net improvement in wages, despite the fact of what looks, because you have to account for inflation. This is the concerning trend. And when you're looking at, too aggressive. When you're looking at the fact that wages is not improving with inflation, this is what, again, we went through this before. This is all the money that was added, the transfer payments from COVID, and we're seeing the COVID money that's been spent, and it should be out in November. And the reason why it's running out is consumers are still using that money to spend and maintain their standard of living. Yeah, we've seen that there's been an uptick in the amount of that's being spent on a percentage of people's income on servicing their debt. And the debt, we're talking about mortgages, we're talking about credit cards and car loans predominantly.
Right.
And to answer the question, we're soon to be talking about student loans. That was the question, and it was a brilliant question. So thank you for that question. So I'm going to weave it in here. Yeah, we do see that student loan payments are expected to start here in about another month's time. That will have a material net negative impact to consumer spending.
Yeah, and another anecdote I would add to that, again, based on what we've heard very recently from, companies like Capital One and Discover, they're already starting to see an increase in their credit card net charge-offs, or they're already kind of preparing for increasing their loan loss provisions, because they do, again, as an important industry members, they do see that kind of picking up because of we'll see those student loan
the consumers are feeling the pinch.
Mm-hmm.
And despite what we're seeing with real personal income, we're seeing real disposable income as a result not keep pace with trend. So again, I started with, isn't this great information on the consumer, but I've provided you the inflation adjusted numbers. And as you're looking at it real on how much people have on a disposable income basis, it's not great. Bob indicates correctly that we're seeing the credit card numbers and auto loan numbers as a percentage of delinquencies. Looky here, auto in gold and credit cards in blue. We're seeing the delinquencies start to creep up. Bob, these numbers, I don't know why we don't have anything that's more updated from March, but I'm fairly certain that the information and anecdotal data I've seen through June, we're continuing to see that trend rise. We'll provide you that information as it comes out. And what we're seeing is this all kind of folds up neatly into consumer confidence. It's this, whether because there's a bunch of ways to measure it. Expectations, the trend for expectations, consumers are expecting less. consumers' current conditions is this trend is not, again, little small improvements here towards the end. Not surprising with the stock market and residential real estate price improvement, but overall, the consumers are feeling the pinch. We know that their wages aren't there. We know that their debt is mounting. We know this is going to have an impact on consumer spending, which we know has an impact on the stock market, which is why we're a little bit more concerned about the second half of the year delivering than the first half, which was clearly a rebound rally, at least in large part from the awful year that was 2022.
Absolutely.
Bonds.
Yeah, I do want to spend a few minutes just talking about bonds. And, again, the clients who've been logging in on these webinars know that these two charts are, are a permanent fixture in this presentation. The one on the left just kind of reminds us again and again that we've seen that long decade, several decade long bull run kind of ending in that bond market, and we've broken through that trend in the last year or so. And while that definitely puts right now, we definitely think that we feel better about the bond market in general versus how we felt about it last year. But look at the chart on the right. It reminds us that 2021 wasn't, that's where follow the laser light. That's 2021. 2022 was brutal in the bond market, wiped out several years of gains that people had in their bond portfolio. And while the trend line so far for 2023 is encouraging, it is still a little bit of a touch and go. Again, use your laser light, Michael, to get us through the March, wherein we were basically just playing around with still negative numbers because, we were talking about banks and a lot of that was going on.
Yes.
And then, we were starting to feel that stress in the bond market again. We've recovered back from those levels. I would say, generally speaking, we're still staying a shorter duration within the bond space, but we do have better feelings about bonds in general versus how we felt about the segment last year.
We do. We have a question about money market. And, I would say, largely speaking, because we do see the Fed increasing rates at least one, possibly two more times, money market, which has been such a horrible place to park capital for a short-term period of time. I would say, largely speaking, we're slightly favorable on the money market comments for you. And secondly, where you see short-term treasury rates going. That's the question. By the way.
Right. And again, we've already, the Fed is already talking about at least 2 rate hikes. One is scheduled tomorrow. It's already priced in. It's almost certain that they're going to announce it tomorrow. And there might be one more on the horizon. So I feel that as a market, we've definitely gotten closer to a point wherein we have a better idea of what that higher number needs to be for the rates before it starts coming down again. And then we know that, bonds, especially the longer dated bonds, become a little more attractive when we move away from that rising interest environment and start moving towards the rates falling. So we'd be watching out for that. Until then, we do think that there are better opportunities on the shorter end of the duration curve within the bond market. So we're basically staying on that side of the curve for now, but actively looking out for opportunities. The 2-year treasury yield did breach the 5% levels for a little bit and then, came back down again, but we'll keep looking for opportunities to lock in those yield wherever we can.
Yeah, and you got a couple more charts here. I just would tell you that also we are, just broadly speaking, it was very hard to get us to put money in bonds. Largely speaking, you may just actually see us do some of that because we are seeing things largely, improve.
Right. And,
broadly speaking, but
right. And that also comes with the fact that, we definitely have seen that your US dollar strength kind of, not as strong as last year because there are other relative options available. Some of the other countries have started catching up on where their bank rates are. So there are other alternatives available in the market from that perspective. So that's definitely starting to reflect a little bit on the US dollar strength, but we still feel pretty good about the relative positioning of the US versus some of the other investment opportunities.
I'm okay to switch.
This is this is an interesting chart. It kind of plays in a few different spectrums of what we wanted to talk about. Obviously, it's relevant for the bond market because we're talking about the US Treasury issuances that are happening now. That obviously plays a role in the demand and supply that we see for treasuries. And this is more about the supply. The debt ceiling issue did put a little bit of a wrench in the Fed's plan overall. So right now they're kind of in a catch-up mode wherein they're issuing a lot more debt just to replenish their cash reserves. And interestingly, a lot of that issuance has also been in T-bills, which another side effect of that is just, a much higher rate of interest being paid on that new issuance of debt that we've seen coming from the Treasury recently, which again has its own far-reaching effects on everything else. But it also casts a shadow on that big objective that the Fed has been wanting to work on. I feel like it's the side project. They try and work on it whenever they can, but it's like one step forward, two step back. And that project being they need to reduce their balance sheet. It's
good luck with that.
Enormous. And I feel like, again, with so much new supply coming in the market, they haven't really made much of a dent on wanting to shrink the balance sheet. So a lot of different cross currents going on in the bond market, both from a demand supply perspective as well.
I have a quick anecdote on that, Bob, and then I'm going to switch off of bonds if I can. So I almost put my glasses on, by the way. Cannot believe I have glasses. I can see. So here's a note that I wrote. In 2022, the average cost on our US debt to the American taxpayers, we were paying 1.6% or about $600 billion of interest. Wow.
Big number, a big number.
Big number, massive.
Massive.
2023, we're expected to pay 2.7% on our interest to finance our debt, which is going to cost us $850 billion.
Wow.
Yeah, and as Bob indicated, that we're using short-term debt largely, and that short-term debt is over 5%.
Mm-hmm.
So at $850 billion, should that end up being the number, that'll be equivalent to about what we're spending on defense.
That is mind-boggling. And I feel like the word trillion has been thrown around so much in the last few years. I feel like millions, billions, and trillions have kind of lost its relevance on us to some extent.
It better
and every
not,
now
but
and
it
then
has.
we can step back and remind ourselves, we're talking about billions and trillions here. That is a really big number and can be taken lightly.
It is not. Now, give me the expected 7-year forecast, Bob. I need it.
Absolutely. And we talked about this in the valuation section. Absolutely. The year-to-date performance that we've seen in the market has definitely made a difference to what our 7-year expectations from the equity market is. And I would say we're starting to kind of shift into more of that low to below average expected returns for the next 7 years when it comes. So, you see the highlighted table, there is more reds and yellows that we would want to see. We would want to see a lot more greens there, but that is, if I put this chart right next to how this chart was looking on December 31st, 2022, there has been a massive shift just because of the year-to-date performance and the multiple expansion that we've already seen in the market so far.
So we're cautious. Conclusions. You ready? I'm ready.
Yes.
Everyone's ready for conclusions. I see more of the questions. I'm trying to weave them in, but we may have to email you separately. So thank you for the questions. Chat on the bottom. Fire away. Okay, look, I'm aware that we've got equal numbers of cases for bull, meaning the market rising, and cases for bear, market to fall. I'm aware that they're both equal, but I'm also aware that these things are really point counted. It's the same thing, just the opposite end of the spectrum. Here's the point. There are a lot of things that are happening to justify the market where it is right now. Consumer spending has been amazing. Inflation's coming down. Government policy has been strong. Revenue's been good and earnings haven't completely collapsed, which is good. The market went up to such a point where it confirms kind of like this bull market. So technicians say bull market's confirmed, and this is good. So, AI is coming, and the bond market's not falling apart, meaning like we're not worried about, things going bankrupt, and residential real estate looks good, and volatility is pretty low. I get all of those things, but leading economic indicators stink. Manufacturing's awful. We talked about that. I told you what's the inflation data that's coming. We went through it point by point by point. But so I'm acknowledging where inflation was, but I'm also looking at where inflation is likely going. And monetary policy, which again, the Fed is still continuing to squeeze. That is not a positive. Real economic activity and the rate of change is slowing. The fundamentals and valuations, Bhavna talked about this in great detail. We know we talked a little bit about banking with financials and the problems there and the potential for real estate. We've talked about the vacancies. We talked about all that stuff. Each and every one of these things, there's point, counterpoint. And so what I will say is that I'm aware of why we're here now. I'm also aware of all of these things that appear to be coming. And so it kind of puts us into this, what was the first half like? What does the second half look like? And what is 2024 likely to look like? So in 2023, the first half of the year was the market came to like this resolution, this greater understanding of that. All right, the banking crisis happened. The debt ceiling is done. The labor market hasn't fallen apart. So all of those fears that we had kind of working their way through the system in 2022, that the market squeezed in. The bond market was concerned and the stock market was concerned, and those concerns turned into real negative performance. Well, didn't come to fruition. Economy is still here. We're still moving, and we had a pretty significant relief rally. So all of that's great. We're aware of it, but we're also aware of this great bull market that is so heavily concentrated to in just a few names that if you look broadly speaking, yeah, we've seen some improvement in stocks, but that's not uncommon. If you have a market that, an economy that's going down, it's not uncommon to have these, secular, little pocket bull markets within. And we just think it was so heavily tilted towards the large stocks, it was a little bit unique in the way it was done. The second half, we do expect to see some resistance. We're expecting inflation to rise and equity multiples, or they're even more expensive, likely, because we don't see the earnings picture meaningfully improving, because we are seeing some margin compression, because we are seeing wages continue to rise. We're expecting to see unemployment to start to rise. We've seen some anecdotal signs throughout the year, but we see those numbers start to work their way through the system likely. So as all of that starts to filter into the system, that provides real resistance to the stock market moving higher. And then in 2024, perhaps some normalization, because really all the COVID, whether it be shutdown, reopening, COVID transfer payments, and PPP loans and debt forgiveness and all of that stuff's washed away. We've got kind of a real normal economic system, hopefully in 2024. And then, we'll start to see what the picture looks like there. And maybe if that is the case, we do have a more normalized economic picture in 2024. We could see some type of potentially bottoming out in the second half of the year and something we can invest on more meaningfully. And these are the three specific, if I can boil it down to all these conclusions into just these three, if I could be so bold, would be one, can the consumer keep spending? We've talked about auto loans. And again, auto loan balances have never been higher. We're seeing defaults come up. Auto loan interest rates haven't been higher. Credit card interest rates haven't been higher. Credit card defaults are starting to come up. Can the consumer keep spending amidst this backdrop when we know wages haven't, on an inflation adjusted basis, really respond? We've gone through that data. So can the consumer keep spending? Can they defy gravity? That's going to tell the tale the second half of the year. We're cautiously optimistic. The banks, will they keep lending? We know lending has come way down. We know that the bank stocks have suddenly gone up. I think that has more to do with the fact that there was a huge amount of people shorting banks, thinking that banks were going to go down. They thought there was going to be worse earnings numbers than there were. They're like, holy cow, I guess banks aren't going out of business. And there was a bunch of people buying those bank stocks back. So I think that explains the bank stock performance. But will the banks keep lending? Will there be a lack of lending that hurts the economy, hurts businesses that need that firepower in order to continue to grow and expand their businesses and meet their earnings estimates. And lastly, is will interest rates and inflation rise and fall? There was a really good question about the war in Ukraine with Russia and what we are seeing with wheat prices. We saw wheat prices hop meaningfully on Friday and again yesterday. We're seeing energy prices start to rise. I don't think that has much to do with Ukraine, as much to do, I think, with strategic petroleum reserves and economic reopenings in China, using a little bit more energy there. So as you're seeing from an inflation perspective, I do think you're going to see inflation rise. I think that also means that, again, the Fed's 2 interest rate increases, I think those end up happening as a result. The Fed's told us it's coming. We think it will come. So if all of that happens, I do think that it ends up creating an economic environment that puts us under a little bit more stress. Oh, good luck reading all these disclosures, by the way. Puts us in a little bit more stress and
Mike, if you may put the slide deck back and go back to that bull and bear slide that we were looking at as to how
I can.
There is a push and a pull. I do want to make a final concluding remark that, you may. I know we've gotten this feedback from clients in the past saying, okay, we digested through a lot of data, and this time we'll be hoping that we gave you a more closing remarks on how we want to wrap this up. But one another thing that I wanted to kind of say on that note is this is the reason, the fact that there is case to be made on why everyone is convinced of a bull run that's happening in the market versus why there are still reasons to be concerned about and headwinds that do exist, is the reason why we are still taking that hedged equity approach.
Yeah, I didn't. Yes.
We're still being putting that cautiously optimistic phrase into action is being mindful of the risk, being mindful of the quality. And I know there was another question which was talking about how our hedged equities have done in relation to the benchmarks, and we can definitely provide you more information on that. But I would say that those hedged equities year to date have actually been holding up really well and have been participating really well in this market, but is also giving us that that assurance that we do have a pretty good handle on what percentage of risk we are taking in our client portfolios. And again, putting that cautious optimism into real practice.
Facts. So yeah, so the answer may be hedged equity for how do we get that continued U.S. exposure in stock exposure, but yet have some protection in the meanwhile, and that hedged equity is one of the great answers. So if you're curious, if you already own it, great. If you're curious about it, just email it. We're happy to tell you more. I got a bunch of other questions I'm going to try to roll through. So if disposable income's trending lower into 2024, why would spending remain strong? So spending would remain strong if we see consumers continuing to use their credit card, number one. Two, if they continue to use their COVID reserves going into, we thought they were going to run out in July because that was the trend. Now it looks like November. Maybe it runs into 2024. Maybe the slope of how quickly they spend their COVID reserves changes.
And three, if the labor market continues to stay strong,
you got it.
Continue to see the wage growth, we can keep this going. And we do think that the labor market right now is not what it's traditionally been, and there's been a lot of changes there. So that would be another thing that would keep the consumers going.
Yeah, I think I got that. So I think I answered that. We got that. So what about business investment being impaired? So great question, Eric. Again, not to just single you out, Eric. I mean, all the questions are good. So thank you. We got the chat button on the bottom, so keep them coming. So I think what you're going to find with business investment traditionally is lending. And the lending environment goes hand in hand with how CapEx or capital expenditures go for businesses. And you're seeing meaningfully less lending that's occurring thus far. I would caution those folks that look at historical context for bank lending, because normally when bank lending, has that 2% or more reduction in loans year on year, the stock market performance is usually pretty terrible because business investment does go down meaningfully. So I think that goes hand in hand. We are watching the banking environment. We see that there's trouble. We see that there's the lending standards are going up, and we're seeing the amount of loan issuance going down. We also know that we've got the looming commercial real estate situation coming down the pike as well. So did I answer Eric's question, you think, about this? Yeah.
Yeah, you did. And then I see another question coming up about hedging that we were
You see
talking
that?
about.
Yeah, perfect.
And then what emphasis is placed on gold and precious metals in the context of that? I would say, again, our approach is to be more creative about how we look at hedge. So we're not only restricted to looking at it from an asset class diversification point of view. We're also looking at direct, indirect, relational hedging, and a combination thereof. So some of the strategies do lean on more direct hedging methods, while the overall asset allocation is always in the context of looking at the client portfolios, and the asset class diversification definitely plays a role in that. But we can chat offline more on that topic, but I don't want to provide that hedging kind of hedging is a much wider word and can have very different meanings in terms of how it's applied to client portfolios.
And so, in one of the ways, so we've got lots of different portfolios, and we do have the gold miners in our tactical and constrained portfolio. If you've got questions, let us know. We'll tell you more about it, because what we do see historically is that at some point we do see interest rates topping out and then coming down. And historically, as interest rates come down, gold prices usually perform well. So we do have things that we are, in some of our portfolios, we have early positioning on, and there are things that we may look at to continue to emphasize that. More questions coming through. Concern on the labor market is the trend of services and general ISM indicators show a potential decline. Yeah, we agree that we do see some challenges with the labor market, and we do forecast some difficulties ahead. And what has been, and Bhavna, don't chastise me, but what has been, I think, the most important linchpin holding all the economic pieces of the puzzle together to create this performance has been a really strong job market. And if we lose that really important linchpin, I personally think that it's going to end up creating some real complications for us, the stock market and greater economy overall. Don't chastise me. Part of that's factual, part of it's opinion based, but we do largely see the trends reversing. Oh, Bhavna, I think we did it. I think we did it.
Yeah, I think we did. We did go a little over time, but I
little
about all the different topics that we talked about, and I loved the last few slides on the conclusion. I feel like we did a really good job at just bringing it all together. Hopefully, we'll get that feedback from people who listen in or will be listening to the replay. And keep coming the feedback. We love the feedback, and we'll try and address in the next one, which will be in a location where the weather is perfect.
Yeah.
You can do it in person.
I agree. So I would also say, I really think, Bhavna, we need to, because we get the audio file and the video. You guys know we'll post the video, but I do think we got to get this audio file out into the podcast realm so people can just download it and listen to it on the run. We don't need people driving and then, on their phone and then looking and
trying to find where your laser light was on the screen. Yeah, that would be disaster.
I think that was a wonderful addition to the podcast. That's just me. All right. Thank you so much for staying tuned in, everyone. We will look forward to seeing you next quarter. If you need anything, please let us know. I'm Michael Carlin. Bhavna, as always, you're the world's greatest. Thank you. Appreciate you, and hope you guys have a great day. Wonderful week. Take care. Bye-bye.
Bye, everyone.